Housing prices are sitting at record levels. Housing affordability is sitting near record lows. We've got mortgage rates bouncing all over the place. So the most reasonable thought for most people is that home prices have to crash. But Josh, traditionally speaking, home prices have been sticky to the upside. So let's take some time here and actually talk about the idea of home prices being sticky to the upside, why home prices aren't likely to crash, so that we can create and help educate home buyers.
Absolutely. Everything we're going to talk about today relates back to the concept that Lance Lambert, our guest on last week's show, introduced of supply and demand equilibrium. Everyone, and not everyone, many people reach out in comments on the live show, in conversations with us. Home prices have to come down. They're unaffordable. No one can afford them. We don't need a lot of people to be able to afford homes. We just need enough people to be able to afford the homes that are available for sale. So in simple terms, we have an equilibrium in most markets between supply and demand. The homes that are available meet enough demand to take them off at the same or slightly higher price. So we do not really have a recipe for rampant appreciation like we saw in 2021, early 22, where rates are low, prices are reasonable, lots of affordability, limited supply, but lots of able demand. We've got limited demand right now, but there are some reasons why this is very unlikely to change in the near future. So let's jump into that.
Well, and to note that same conversation, Lance noting bifurcation, right, where some areas of the market might experience some imbalance, if you will, or more supply than you have buyer demand, and therefore you might see prices come down. But what we're really talking about here isn't prices leveling off, prices coming down. We're talking about the idea of a crash. Why a crash is not likely. And in a lot of markets out there, you're not really going to see that pullback in prices either, at least in the near term. And it comes down to supply and demand. But on top of that, let's just talk about the general premise of home prices being sticky to the upside with, the basis here: necessity, emotional attachment, and the idea of illiquidity. So when we talk about those three things, Josh, what are we actually talking about?
The necessity is probably the most important part. We get a lot of these really smart Wall Street analysts and tycoons telling us, hey, housing is fundamentally overvalued. They're looking at it like a stock, and they say, based on my metrics, it should be 30% lower. And they may be correct. But the reality is no one needs to own a stock. They do have a necessity to have a roof over their head. So what are our options? Some people have the option of living rent-free. They can move in with family. They can couch surf with their friends. There are a minority of people who can live rent-free. Other people can rent and put a roof over their head, or they can buy a home and put a roof over their head. Once someone has joined that roughly 2/3 majority of American households that want to own their home, they are very reticent to go back to being renters or living rent-free, moving back in with their family. So there is a strong incentive to remain a homeowner, to fill that necessity for having a roof over your head. So it's not a fair comparison to look at it as a stock or a mutual fund or something in your 401k. And there's another bigger comparison to that where we talk about that illiquidity. If you own an exchange traded fund in your 401k and you go, oh, that sucks. Let's say the TLT. The TLT is an exchange traded fund that trades long-term treasury bonds. Rates have been terrible, so it's got terrible returns over the last 2 years. Many people looked up and go, ooh, that sucks. I don't want to own it anymore. It doesn't perform any utility in my life other than making me money. It's not making me money. I'm going to dump it. You push a button, and for little to no cost, it is gone. Your house is very, very different than that. If you go to sell your house, you have to call someone like Jeb. You have to interview a few of them. You got to figure out, what is my home worth? What are you going to charge? What is the buyer's agent wanting to be compensated? What are all of the other charges in there? Depending on where you are and what you're able to negotiate, you're looking at 5 to 8% of the value of that property going away, and having a long drawn out process of having to show your home to strangers, having to do repairs to your home, having appraisals, inspections. So it is not in any way liquid like stocks, mutual funds, ETFs. So to compare the two of them, to think that they would trade similarly, is a little bit absurd.
Josh, that's a perfect segue into, if you need a real estate agent or you want to work with Josh and our team on the mortgage side do us a favor. There's a referral link actually in the description of this video where you can get connected with us. We can have a conversation about your situation and help guide you, based on what your goals are. And if you find any value in the content that we're doing here, do us a favor, hit the thumbs up and subscribe to the channel if you haven't done so already. So Josh, that kind of takes us into that emotional piece of the three things that we're talking about here. And the emotional piece actually can go back to talking about stocks to some degree, because, one thing I learned in having mentors in the stock market and that sort of thing is, like, people, when they buy a stock, for example, say they bought Apple at $100. If Apple falls to $80 and they still have it in their portfolio, most people will refuse to sell that stock until it gets back to $100, because it's an emotional thing. It's, hey, I'm not going to lose money on this. It's in my account. I haven't actually lost money until I sell it. Therefore, I'm just going to wait forever. And sometimes it may take forever for that stock to get back up to that price. Sometimes it may never do it at all, but it's that emotional piece that, hey, once it gets back to where I bought it, I'm going to sell it. And then typically what happens from there is it just goes gangbusters and continues going up, and those people lose out on the gains. But where that relates to home prices is, if I'm a homeowner, Josh, and I'm in my neighborhood and there's a similar house down the street goes on the market for, say, $1 million, well, I immediately think my house is now worth $1 million, right? 100%. Because my house is nicer. That's what all sellers think. My house is in a better location. Those people did some crazy things to their house. I never did that. I'm better in all ways. So I'm never going to sell my house for any less than John sold his house for down the street. Therefore, mine's $1 million. Well, guess what happens as the market corrects? In some cases, more inventory comes to the market. Prices, in some cases, do come down on a nationwide basis, but that seller always goes back to, you know what? John sold his house for $1 million. I am not going to sell my house for any less than $1 million because John's house sucked and mine is better. Right?
Absolutely. And that piece of, I have to have a roof over my head, costs me a lot to sell it. I'm attached to my price because I have the greatest of all of these semi-similar assets, and I am not going to let it go for less than that price when I can just post up and let time pass. Probably the best example I have. My mom in the late 70s, early 80s bought a house here in Huntington Beach, made a bunch of money on it. In 1989, moved to Temecula, and she said, hey, I'm going to make my next $100,000 out there on that house. She paid $179,000 for the house. In the 89, 90, 91, it probably ran up before we hit that 91 recession to the low twos, 210, 220. At one point, that house was only worth $130,000, $140,000. Did she sell it? No, she didn't sell it. She waited and waited and waited and waited and waited and ended up selling the house for about $325,000. And what will my mother tell you? She will tell you, well, I told you I was going to make $100,000 on that house. I made $100,000. It made more than that. It went from 179 to 325. She ended up owning the home for 89 to like 2009, almost 20 years. The plan wasn't for 20 years, but that's how homeowners think. Mm-hmm. They don't look at real returns on their housing investment. They look at nominal returns. Did it go up in value? So they don't take into account that over that 20 years, inflation could have eaten up all of that gain. I may have not had any increase in the value. They're just looking at the home price. And we're going to go through here in the next step here, why that's actually rational, why that's a logical way of looking at it for homeowners.
Well, actually, let's start with an example here. When we're talking about nominal home prices, we're talking about inflation. If you bought a $300,000 home in January of 2010, inflation alone would take that home today at $427,000. So just inflation alone took that $300,000 home to $427,000. So $127,000 without buyer demand being crazy, without, competition in the market and everybody fighting and paying over a house, just that in and of itself. And so, the Fed has a dual mandate. One is maximum employment. The other one is price stability. And for the Fed, price stability means annual growth somewhere around 2%. 2% is their target. Right now, we're sitting in the high threes. And so, you've got, if we're able to maintain 2% for the better part of 10 years, we couldn't even get to 2%. But just 2% alone means your home price is continually going up on a nominal basis. Every single year, just with what's happening out there in in how the Fed is doing their mandate.
Absolutely. And if we look over the last 2 years, homes have dropped in value. When you say that, people go, you're crazy. I see the headlines all the time. Homes are up 5% year over year, 6% year over year. Over the last 2 years, on a nominal basis, homes have lost value because inflation went up higher than home values went up. That has not been the case historically. And most importantly, we're going to get into limited supply and how there is not enough housing. So if we go back over the last 50 years, home prices have appreciated at a rate higher than inflation. Mm-hmm. So if we say inflation averages 2% over the long haul, which is looking more difficult day by day, but it has over the last 20 years, likely to over the next 20 years, 2 to 3%. And home prices may or may not get a little bit more than that. But if your average home buyer puts 3 to 5% down and they get a 2% return on that every year, they're getting a 40 to 50% gain on the money that they invested. And that compounds over time. That person that bought for $300,000 with a 3% down in 2010, Jeb, they put $9,000 down. With closing costs, they were maybe into it for $15,000. If it only kept pace with inflation, they're up $427,000. They covered that necessity of a roof over their head for the last 12 years. They paid that mortgage down. They probably owe about $210,000. They refinanced from the 5% from that time down to about 2.5%, 3.5%. Mm-hmm. So they have a spectacularly low cost of housing. And the cherry on top is that housing actually doubled. It didn't just follow the rate of inflation. So that $300,000 house is $600,000. They owe $200,000 on it. They have $400,000 of equity, and they're paying half of what they would be paying in rent. These are the reasons why the system is designed to reward homeowners. If we just keep with pace with inflation, which we don't, we exceed that over the long haul. It's a leveraged investment. It covers a necessity. It gives you talked about the emotional component of just thinking, hey, I don't want to realize a loss if someone else sells for less in the neighborhood. You also just have that component of, this is my nest. This is my home. We had our kids here. We raised our kids here. There is so much heavy emotional stuff about a house that you own that you don't have with a rental property, even if it's a single family residence. So from that perspective, the system is designed to do this. It is designed to keep prices elevated, and we should expect it to be behaving the way it is, despite the fact that we can acknowledge that in real terms, home prices are cheaper than they were 2 years ago. Now, don't go crazy in the comments saying Josh is insane, saying home prices are cheap. They are cheaper on an inflation adjusted basis than where they were 2 years ago.
Well, and you mentioned leverage a moment ago, Josh, and important to note, leverage when it comes to buying a home. You can finance this asset with, if you will, using government-backed products like FHA, some cases VA if you're approved, putting little to no money down, and be able to take on this entire asset with a small amount of money and finance it over a 30-year fixed period at a fixed rate. So as rents are going higher, the cost of living is getting more expensive. In theory, your housing costs are somewhat fixed. Now, there are things like, insurance that have been a rising cost here recently. We've got property taxes in some states that, depending on what happens with prices, they see, crazy increases annually as well. But for the majority of homeowners out there, buying a home now, fixing that cost the earlier you can fix that cost in your life, the better off you're going to be long term. And at some point, you're going to own that house free and clear, assuming you continue to make the payments. And the renter who just rents forever when they're 65, 70, whatever retirement age is, they're still, paying whatever the going rate is at that time, which is going to be significantly higher than it is today. But Josh, let's kind of transition out of that because, I know that's going to get a lot of comments. In fact, if you have a comment, are Josh and I absolutely crazy for thinking that home prices are sticky to the upside? Let us know in the comments below. I always love hearing the thoughts, but back it up. Back it up with some information other than you guys are nuts. Give us something to go off of. But Josh, let's talk about it from homeowners, their financial position, if you will. Let's talk a little bit about equity. Let's talk about rates. Let's talk about what is kind of the catalyst that's keeping people in their property right now and why, if we have some sort of black swan event, if we have unemployment go up, how the majority of these homeowners are essentially not isolated, but they're in good shape. I can't think of the word that I'm trying to use. Insulated. There we go. That's what the word I was looking for. Insulated, not isolated. Insulated. But anyhow, let's talk about that.
So we kind of hinted at this with that example that you gave, Jeb, of the $300,000 purchase in 2010. And in 2010, that one actually would have been high. The nationwide median was below that. But that person put $10,000 to $15,000 into acquiring that home, and they now have about $400,000 of equity with a payment much lower than what current rents are. So let's look at, from the FHFA, they put out these numbers. They tell us that nearly 40% of homeowners own their home free and clear. So they are at no risk of losing their home, no need of selling their home. They just need to pay the property taxes and the insurance, like you hinted at. Of the other 60%, 60.7% or whatever that have mortgages, 69% of those people owe less than 60% of their home's value, meaning they got 40% equity in their home. So like that example we just talked about, that person that bought in 2010 has got 30 or 60% equity in their property. 91.2% owe less than 80% of their home's value. So if homes corrected and dropped 10% and someone found themselves in a pickle, that's not a short sale. That's not a foreclosure. That is put a sign in the yard and sell that house with a fairly steep correction, which does not appear to be on the horizon. So we don't have that recipe for people having forced sales. Worse than a forced sale. I mean, if someone loses their job, if someone loses a spouse, half of the income goes away and they can't make the payment, there can and will be forced sales. We talk about all the time. Things happen that make people move: death, divorce,
Absolutely.
Job loss, all of that stuff. It just doesn't happen at scale, which is what is required to have a crash or a large scale correction. Now, let's go into the details on the mortgages. For those 60% of people that have mortgages, 58% of them are under 4%. Another 19% are under 5%. And then another almost 10% are under 6%. So we're talking there 76% of people under 5%, with the majority of them under 4%, and 86% of people with a rate under 6%. So I put an example together here. For some of you in lower price markets around the country, this example is going to seem crazy. But for us in Southern California, one of the more affordable Orange County neighborhoods, very popular with first-time buyers, is Anaheim, right near Disneyland. I looked up a home for sale today, $825,000. And I said, what if someone bought this 5 years ago? Let's not go back to 2010, which was almost literally the perfect time to ever buy a home. But if we go back to 2019, that home would have sold for about $600,000. That borrower would have likely refinanced 2 years later in 2021 down to about a 3.25. They probably bought somewhere in the mid to low fours, but they got to drop that a full percent. Today, their principal, interest, taxes, insurance, $3,270 a month. If they had to sell that home, they still have the necessity of a roof over their head. Renting a similar property is $3,900 on the low end to $4,200 on the high end a month. So they have $700 higher a month with no tax benefits, no forced savings in terms of money going towards principal every month. No, none of that, no benefit of appreciation. And the reality is they're probably going to go, no, I can't afford that. If I can't afford my house at $3,270, I have to sell it. Now I got to go find an apartment. I don't know about you, Jeb. Apartments in Orange County, you cannot find anything with more than 2 bedrooms for under $3,000. So that person is likely looking at a very similar payment to rent something substantially inferior if they had to give up that home. And the important part to remember is that house is worth $825. That borrower, if they did that, they refinanced one time, didn't take cash out, they've amortized it down over that time frame, having paid $600, they probably owe somewhere around $540,000, $550,000. So they're sitting on $250,000 plus of equity with a payment $700 to $1,000 lower than what an equivalent rent payment would be. You can start to see why, despite the fact that their desire would be to hold on, they will hold on for dear life, and selling that home will be the last option. Doesn't mean no one will be forced to. It means you got to get some pretty serious hard times before you let that go, when those are your options or alternatives.
Well, let's use another example. Let's use George. George, for example, is a client of mine, bought a property here in Huntington Beach, small little 1-bedroom condo back in, I don't know, Josh, 2019, probably about
2019
2019
or 2020. Yeah.
Was a veteran, was able to finance the property at that time. Don't know what the rate is, but at some point was able to refinance it down to 2.125%, 2.125. He calls me about once every 6 months and he says, Jeb, I'm ready to sell my house. And the conversation's always the same. Have you looked at what's out there? Yeah, I've looked at what's out there. I'm ready this time. I'm ready to go sell my house. So we go through the process. We get everything ready up to the point where we're ready to put it on the market. And I say, George, before we do this, you understand that you're going to be paying more money to go find something else than you are paying to own this home right now. And then he kind of pauses and he says, no, I thought I could go find something less expensive. George, what are you doing? Like, well, I want you to go out there and look at properties. And he goes out and he looks and he comes back and he goes, yeah, I can't find anything less expensive. It doesn't make any sense to sell my house. Exactly. So that is the example. And I realize he bought it a really good time. He got a really good interest rate. Not everybody is in that position. I understand that. So that there will be people, Josh, that do need to sell at some point. There will be people that are in distress situations, but everybody thinks the people that have to sell have to let their property go at a discount. Understand there is $16.6 trillion in homeowner equity at the end of 2023. And I don't know the number right in front of me. I don't have it, but the large majority of homeowners have equity in their property, which means if they need to sell it, they sell it at market value. Well, when homes sell at market value, that doesn't put pressure on lowering prices in a neighborhood. That just means it's selling for what other homes in the neighborhood sell for. What you need in order to see cascading price declines is you need the next seller to come on the market and sell their home for the less than the last person that put their home on the market. And that only happens when there is 14% unemployment, like we saw back in 2008, when people are over leveraged on their homes because they put absolutely no money down, when they finance a property on an adjustable rate mortgage that's now adjusting and they need to refinance it and they can't because they have absolutely no equity in their property. This is not that time, right? So taking us back, Josh, we can talk about foreclosures. We can talk about all of that, which we're going to.
Absolutely. Let's flip the example that I just gave you. The person that bought in 2019, why they would never want to walk away unless it was their absolute last resort and sell that home. The first home that I flipped in 2008, we bought it in October of 2008. That gentleman had bought the home in 2006. He lost it at the trustee's sale. We bought it from the investor that bought it at the courthouse steps. We paid $265. 2 years earlier, he paid $675. He was on a 228 arm. Most of you are going, what in God's name is a 228 arm? Because they don't exist anymore. It was a loan that was fixed for 2 years. And in 24 months, you better have got your shit together and have a better credit score and some equity in that home, or you're in big trouble, just like this guy. So what had happened is his payment spiked at the end of the 2 years to $6,000 a month. The house was awful. Like, we did a complete stem to stern remodel on it because it was disgusting. And I show up to tell the guy, hey, I own the home. We need to make arrangements for you to move out. And he's like, nope, hire the lawyer. We're going to stay. I go, well, here's the deed. I am the owner. So there's no unwinding this, no fixing it. And I said, but tell me more importantly, if you wanted to stay here, why you want to stay here? Your payment is how much? So $6,000 a month. Cool. Says, is this a nice house? He goes, well, we're working on it. We're trying to make it better. I said, okay, see that real nice one across the street with the for rent sign? Oh yeah, that's a nice house. You know what that rent's for? $2,000. So I said, you can get your stuff, move out and go rent from that guy for $2,000, or you can stay here and be $500,000 upside down and pay $6,000 a month. It's a pretty easy decision. You could see the light bulb go on in his head and he goes, yeah, that's stupid. And they were out by the end of the weekend. And it had never been explained to him. But that is why we had homeowners en masse just, here's the keys. I'm walking, I'm moving, to have the house back. So what you said, Jeb, putting a bow on that, Southern California is a cyclical market. We have had 4 cycles of downturns over the last 40, 50 years. Every one of those The primary characteristic of it is at least 20% of the available inventory in the multiple listing service is bank-owned properties. So you're going to go into the details for us on how we would ever get to 2% of the properties in the MLS being bank-owned. But that is what is required, because banks are not in the business of owning a home. They don't need a roof over their head. They don't have an emotional attachment to that home. They do not want it on their books. They will sell it at any cost. So we don't have a recipe for walking away. We don't have a recipe for it ending up in the hands of the banks. So we do not have a recipe for sellers letting homes go well below where the current market is.
And let me save you some time. If you're one of those commenters that's going to say, well, what about the shadow inventory? I'm going to tell you right now, there's no shadow inventory. So you can actually hold that comment to yourself for another time in another market. But let's talk, Josh, before we dive into kind of the characteristics of delinquencies and foreclosures and what that looks like. Let's talk a bit about the government, not in a political sense, but about what they've done during the financial crisis of 2008. And what we've seen since then, like say during the pandemic, we saw, so taking us back to 2008, what we saw towards the end of it, maybe in the middle of it, not initially, but towards the middle of it, what we started to see was a loan modification, right? People would go back to the bank and basically say, hey, listen, this is what happened. My loan's adjusting. I can't pay the $6,000 a month, but I can pay $3,200 a month or whatever the number is. And the bank would look at the documents and look at your income and say, okay, we'll modify your loan because we don't want a foreclosure. We don't want the cost associated with that. We don't want anything to do with that. So we're going to modify that loan and we're just going to wipe away what you don't owe. And, in some cases got rid of seconds entirely, and they modified loans. And on top of that, Josh, during the pandemic, COVID, we saw the banks starting to do forbearance, which was another vehicle, if you will, to allow homeowners to stay in their properties and change the terms of their loan to give them some sort of relief to stay in that property. So I ask you, Josh, are homes too big to fail? Are they like banks now? Are we in a position where if something did happen, crisis-wise, that somebody's going to save the day because that's the world that we've created?
Well, here, Jeb is a much younger man than I am, at least 4 to 6 years younger. And so therefore his recollections of 2008 are not nearly as vivid as mine. People could ask for a modification in 2008. If they were lucky by 2011, having applied 7 to 12 times, they might get a $50 decrease in their payment. And the rare occasion someone would get a reduction in their principal. So we were doing a bailout for Fannie and Freddie. We were doing a bailout for major banks, but we weren't doing a bailout for homeowners. And it made things much, much, much worse. It would have been better for a bank to go to the guy that I bought that house from and say, hey, we'll reduce your principal down to $400,000. We're going to put it at a 4.5% fixed rate. And can you pay us $2,800 a month? That guy would have said, hell yeah. And they would have had a much smaller loss. But they were saying, well, that's moral hazard. As soon as you bail people out and give them an option, then it's not good. So the downturn of 2008, 2009, 2010 was magnified by the unwillingness of the banks who were receiving bailouts to not give any type of concession to homeowners. So flash forward to the pandemic, and the first thing we saw, you're 100% correct, Jeb, immediately, within like a week, the government said, hey, forbearance to anyone that asks for any reason. So FHA, VA, USDA, Fannie Mae, Freddie Mac loans, all they have to do is say, I am having a hardship, put me in forbearance, which means I don't have to make the payments for a predefined or undetermined.
Well, it changed a couple of times. It started out as 90 days. You had to pay it all back in 90 days, and they started going, well, that's crazy. Like, who can not make miss a payment for 3 months and then all of a sudden come up with all the money? But over time it changed, and
what that ended up
like
with, Jeb, the people who couldn't get to the end of it and refinance and take advantage of the awesome rates, because most people that took forbearance did not need it. They could have made their payment. They put some extra money in the bank and they get to the end of it and they go, hey, the school rates are lower. Let me do a refinance. And after making 3 on-time payments, they could do a refinance. But those that couldn't, the ones that really had trouble, I have a client right now that they went through that. And the bank gave them a modification. They didn't have to ask. The bank said, hey, you're at the end of the forbearance. Here's the terms of the modification. Can you make this payment? If so, sign this and start making those payments. So we went from no world are we wanting to modify things unless we absolutely have to realizing that that is a better outcome. The more people that you can keep in homes and keep from having a large amount of bank-owned property. So whatever the next crisis is, we can expect at least government-backed mortgage lenders to be very accommodating in trying to keep homeowners in their homes.
Which in turn keeps prices sticky to the upside. But Josh, let's talk about supply and demand. We talked about it to start the show. Markets, that's what drives real estate in general. It drives any market. It doesn't have to be real estate. It could drive the car market, can drive jewelry, diamonds, gold, whatever. Everything is based on supply and demand. But with that, Josh, let's talk about supply, because that's the key ingredient at the moment. Inventory nationwide at the moment sits around 526,000 single family homes at the time we're recording this. That's about 30% more than a year ago, which is, wow, that's a huge jump. We've got a lot more homes on the market. But if we look back to 2019, a more normal market, we're well below those numbers. We were sitting somewhere around 1 million, just over 1 million at that time. Take us back to 2015, a more normal market. Those levels back then, 1,042,000 homes on the market. So 1,042,000 homes on the market, rather. So you can see context, right? We're above last year, positive. We're trending in the right direction, but we're still well below where we need to be in order to see a price decline. Because 2015, even when inventory was sitting at 1 million, the market was still moving upward. We weren't in a downward market by any means. Now, I realize at the moment, if we had 1 million homes on the market now, prices would probably come down a little bit because demand would be much less than the available supply of homes because of where rates are, affordability, and all those things we talked about earlier. But we're not there. And now some markets, Florida, some markets, Texas, we're starting to see those inventory levels go back to 2019 levels. And so those markets are slowing down. So in those markets, you can start to see prices move down a little bit, prices move sideways a little bit. But you're still not, you don't have the recipe for, big price declines. And a lot of it comes down to delinquencies, Josh. Serious delinquencies decreased to 0.53% in February from 0.54% in January. The serious delinquency rate is down from 0.62% in February of 2023, which is below pre-pandemic levels. On top of that, foreclosures are 25% below pre-pandemic levels and the lowest level that we've seen since March of 2022. So there's nothing at the moment setting up to see this major move in price stability, taking prices the other direction. And I know we have some numbers on building permits and other major firms talking about housing shortages as well.
Yeah, those numbers that you just gave us, Jeb, are basically existing homes. Here's what's happening in existing homes. They're not being brought to market at a mass level. They're not being lost to the banks that will have to bring them to market at a high level. So let's look at builders. What are builders doing? Building permits came out yesterday, or maybe it was even this morning, fell to 1.46 million annualized rate, but they're not, completions are nowhere near that level. Single family permits were down in all 6 regions throughout the U.S. They were down 5.3% in the South, which is the largest market for building. They have the most land, affordable, sun, people love going there, down 5.3% in the most populous area. So when we look at it, we went through this with Lance. He put out a great chart here about a month ago. 11 major research firms have done the numbers, have run the numbers on how undersupplied the U.S. housing market is. The most conservative says we're 1 million units short. The most aggressive says we're 4.4 million units short. So
it's probably somewhere in the middle.
Probably somewhere in the middle, somewhere between 2 and 3 million units short. We are decreasing building. We've pushed a lot of the smaller local builders out with inflation, with high interest rate, hard to get financing. And now all we have is the big national builders, which we've talked about ad nauseum here on the show, that what do they want to build? They want to build nice, big, fancy, profitable homes, not nice entry-level homes. So for all of these reasons, going back to the top of the show, Jeb, the problem, if you are looking for lower home prices, is we have supply and demand equilibrium. We don't have a lot of supply. We don't have a lot of demand, but they are equal. The only thing of all of these that would likely push supply up would be higher interest rates. Higher interest rates wouldn't be helpful for demand. So that could happen. That could be the thing. None of us expect it. The government doesn't expect it. You don't expect it. I don't expect it, but it is a possibility of rates going higher. But if we go the other direction and rates come back in at all, we have demographics of people aging into prime home buying age, demographics of people who feel trapped in their current home, buy golden handcuffs with a super low interest rate. And if rates got a little bit lower, they would be willing to let their house go and move up to a bigger home and bring that inventory to market. But short of a spike in interest rates from already very high levels, I do not see how we change this level of equilibrium. So listen, it's very important that you guys hear this. Neither of us are saying, hey, home prices are going to the moon or buy now. It's likely more of the same. What we've seen since the beginning of 23 through now, which is just a slow and steady upward trend because few people are willing to sell and those that are find enough demand. But then back to the also more important point, Jeb, we say it all the time on the show, all real estate is local. You do not care what's happening on a national level. If you're in Austin, you don't care what's happening in Anaheim. If you're in Tampa, you don't care what's happening in Boston. You need to have the data for your market because there are markets that are softening where you may be able to get a small dip in prices or pay less for a home than you would have 1 to 2 years ago. And on top of that, remember, when we take into account inflation, homes are cheaper than they were 2 years ago.
Yeah. And if we see 3% appreciation this year, guess what? In real terms, home values didn't really increase at all because inflation is sitting at 3%. In fact, probably losing money a little bit because if inflation's above 3%. So just understand, this isn't a push to get you to go buy a house. It's about educating homeowners or potential home buyers rather, so that you can make the best decisions when it's the right time in your life. And we often talk about it, but we'll reiterate it again. Longer term time horizon, money in the bank, being comfortable with the payment, even if you don't like it, just knowing, hey, if something goes wrong, stuff hits the fan, I'm in a position to continue making that payment. Those are the important pieces because guess what? If home prices did crash, for example, guess what happens to your house? Nothing. Nobody takes it away. You don't have to live on the street. As long as you continue making your payments, you get to stay in your house. You get to own that piece of real estate, if you will. And over time, values are likely to continue moving up as they've done over the last 65 years, sitting at 4.6 to 4.7% appreciation. And as we always say, real estate's a long-term game, but it's more about buying when it's the right time in your life, which is why we always say buy right, borrow smart, and build wealth. Josh, any last any last things you want to throw out there?
We always like these to be words of encouragement. It is a tough market. Affordability is very strained. We would love to say, hey, here's what gets better. To make affordability better, we only have 3 options: better interest rates, higher wages, or lower home prices. We just went through in 35 minutes here of why we don't expect significantly lower home prices in the near future. Wages are trending up barely above the rate of inflation, so not really tipping the scales a whole lot. And we do still believe that at some point, as long as the government stops adding $1 trillion to the federal debt every 100 days, we will see interest rates moderate, not going back to 3% anytime in the near future. But if you, instead of at 6.99 or 7.25, we're at 5.99, it makes things much easier. So the whole purpose of the show every week, this week especially, is just to arm you with the facts to make the best decisions for you to determine if now is the right time in your life to make that long-term decision to become a homeowner.
All right, guys, we'll see you next week. Adios.
Au revoir. Au revoir, baby. Au revoir, Simone.